Everyone, and welcome to the webinar. I can see that we're having attendees join. We've already got over 100 now, so we'll just wait until the 3 o'clock start time, and then we'll kick off with the webinar. So please just bear with us while we wait for everyone to join. Okay, it's 3 o'clock. So hello, everybody. Thank you very much for joining us this afternoon for the European Road Freight Rates benchmark for Q3 2022, brought to you by TI, Upply and IRU. We're very happy to welcome you all again for another session with us, looking into the development of road freight rates across the European market. Of course, we're looking ahead now at a difficult period for the global economy, and right across Europe, we're starting to see some fairly challenging forecasts come in. And the road freight market now is looking at volumes softening substantially as demand slips across most of Europe, although there is quite a lot of variation between countries. So a bit of uncertainty really in the market in terms of understanding what's coming and how costs and prices are likely to change. We know, of course, that volumes are likely to soften, which should bring down prices. But of course, we speak about quite often the supply side constraints all across Europe with driver shortages, vehicle shortages as well, constraining capacity. So today, I think we'd like to drill into a bit more detail on how those things are balancing out, the data we see from Q3, and also to give you some ideas about prospects for the coming weeks and months based on the very latest data, which we can see for each individual lane. So as usual, for those of you who follow these sessions, the presentation part will last for about 25 minutes. So we'll go through, first of all, the overall European situation, and then we'll dive into some specific lanes. Marianne will also be bringing us some insights on the supply side constraints as well from IRU. And then we'll move on to a Q&A session. So please do feel free to submit your questions through the Q&A function on Zoom. That will enable you to log them. And then at the end, we'll try and work our way through as many questions as we possibly can. Okay, so I'll move on to introducing our panelists today. Just to mention, we've now got 400 attendees on the call, so it's great to see such a good community using the data and intelligence from this report and the applied data. That's wonderful. But I should first really introduce myself. I'm Michael Clover, TI's Head of Commercial Development, and I'll be your host today. I'm also joined by my colleague, Nathaniel Donaldson, who's one of our economic analysts and is fundamental to the analysis from this report. Hi, Nathan. Thanks for joining us.
Hello, everyone. Nice to be here.
And we also have Marianne Savoni on the line as well from IRU. Hello, Marianne.
Yeah, good afternoon to all.
Marianne, just quickly, for those of people who don't know IRU, would you just mind giving a quick introduction?
Yeah, sure. So IRU is the International Road Transport Organization. So we are representing road transport sector worldwide in more than 80 countries. We are representing both goods and passenger sector. And our members are composed of road national transport associations, large transport operators. We have truck and buses manufacturers, shippers, and service providers.
Thanks, Marianne. And just before I introduce Thomas, I must remember to read out our little disclaimer here. It's just to remind you all that discussions and statements made by participants on commercially or strategically sensitive information may fall within the scope of competition law and be considered as unlawful. We invite you to refrain from sharing any information of such nature or entering into any such discussion, including during breaks. Okay, Thomas, thanks very much for joining us. It's good to have you on again. Would you like to just perhaps give us a bit of a background on Upply and maybe just tell everyone a bit about the methodology before we move into examining the data and seeing what's going on in the market?
Yeah, thank you, Michael. Hello, everybody. Pretty nice to be with you once again. We are more than about 500 people right now connected. It's just amazing. And I mean, Upply, will introduce it quite quickly. Upply is a company that is the directly in the supply chain, a supply tech organization, tech people working for the supply chain, and we are today the European leader for market analytics regarding data, pricing also for road transportation, but also for air freight and sea freight. But today the focus will be on road transportation, as you know. Quite quick sum up of the methodology, because then we will see a lot of data and not a lot of analysis based on this data. At Upply, we collect data directly from our users that are freight forwarders or shippers, and we are directly connected to the IT system of these guys. For instance, to the the management tool for tenders or for transportation, the TMS of shippers, where we collect on a daily basis the data for road transportation, air freight and sea freight. And here we will look only at data for FTL, full truckloads in Europe, that is general cargo, both spot and contractual prices, and the fuel will be included. Of course, we have the granularity then to exclude it and to see only spot or to see reefers, for instance, but this is for another time. And we will see later on, we have a strong analysis also regarding the fuel, the impact of the fuel, or the impact also on cost basis of the freight and the FTL freight.
Brilliant, Jess. Thank you very much, Tom. It's always good for an understanding really of the data that's available. And we're focusing on in this webinar, of course, but that also gives you a perspective of some of the other data that Upply have behind the scenes. So if you do want to get that really granular level of data, you please should contact Thomas and the team at Upply. I also should say that Transport Intelligence, you know, as Nathan and I's organization we represent on this call, is there as a provider of more strategic analysis on the market. So if you want to understand the other trends like that we talk about today, then you'd contact us. I forgot to introduce our company today. But we'll move on to the first bit of analysis. And really here we're looking at our overall European index. So this averages out all of the international lanes which we're looking at in the European market, and it can show us, you know, the overall position. And of course, you'll note that we have again here from Upply the spot and contract rates, so we can break out and understand how those things are changing slightly differently. Nathan, you're going to take us through this one, but it's really interesting to see obviously rates still rising. So just explain what's driven that over Q3, but maybe also just comment on sort of situation we're seeing towards the end of the quarter in the more granular data as well.
Yeah, sure. Thank you, Michael. So what we're seeing here, so first of all, yeah, as Michael mentioned, we're showing analysis and providing analysis on both the spot and contract markets for the second time now. Now, both indexes have gone on to reach a new all-time high in Q3, but we do see that the acceleration has slowed from the previous quarter. So the contract rates now sit at 129.7 index points. That's following a 5.4% increase in Q3, and it leaves them up 19.6 points year on year. And in the spot market, we're seeing it now hitting 142.6 index points. So that's after a 6% increase in the latest quarter. So 6-point quarter-on-quarter increase, and that puts it up 26.4 points year on year. So what we're seeing here in the prices in these new all-time highs is the European carriers adjusting to the new higher cost environment that they face following the Ukrainian war. They're facing higher fuel prices, which we saw initially towards the end of Q1. We saw that really affect the prices in Q2, and they're also now facing worsening driver shortage, which my colleague Marianne will take you through in the following section. But this does mean that it's allowed it to continue on to this new record high, but it has been dampened by falling demand. So we're seeing falling demand across the continent. We're seeing it both on a consumer side, where we're seeing official figures from the UK and France showing that consumption is falling. And we're also seeing falling production in the UK and Germany in face of higher inflation on the consumer side and high energy prices on the producer side. In addition, we're also seeing effects from the climate. So after a blistering summer this year, we've got record low harvests in some sectors, and we're also seeing early harvesting, which pushed some demand from quarter 4 into quarter 3, and then we're expecting less demand in quarter 4. So overall, we're seeing a higher cost environment. We're seeing falling demand from both consumers and producers, which should ease the pressure. It has eased the upwards pressure this quarter and should into quarter 4 as well.
Yeah, so very interesting, really looking back at some of the issues we had over the summer there. But as Nathan says, there is that expectation for Q4 really that things are beginning to ease off in terms of upward pressure on rates. But certainly, we've still got those factors around fuel prices, which are having a big influence. And I think Marianne will be able to take us through some of those more sort of supply side factors, which are constraining or raising, helping to keep prices elevated anyway. So Marianne, would you take us through first of all the fuel prices?
Yeah, sure. So indeed, let's have a look on the trend of the diesel prices at pump for the main European economies that you see on the graph since the beginning of the year. As a reminder, diesel prices usually accounts for 1/3 of the total operating transport costs. Following the beginning of the war in Ukraine at the end of February, diesel prices remain elevated. Diesel prices in Q3 see an increase of 11% versus Q1, with an average price at the pump of 1.9 euro per liter. And many European countries have cut fuel duties to limit the impact of price increase. According to the US Energy Information Administration, the WTI crude oil price was in average $93 per barrel in Q3. So down 14% versus Q2. However, with the announcement of the International Organization of Exporting Countries of Petroleum, there is going to be a reduction of oil production of 2 million barrels per day in November, representing 2% of the global oil supply. So we expect that oil prices are going to remain high, with around $86 per barrel in November, December, and January of next year. So meaning that the diesel prices could remain high and maintaining the cost pressure on logistics supply chain, globally speaking.
Thanks, Marianne. Yeah, so unfortunately not too much let up on fuel prices, even though we have seen had been seeing some dips from the original peaks. We see fuel prices still remaining high. So that's one supply side factor. Something else that IRU is always looking at is driver shortages and that sort of thing. So Marianne, there's some more new data from IRU on that. Would you walk us through this?
Yeah, indeed. So as you said, Michael, another driver of the transport cost is indeed the human element. So we all know that the driver shortage is continuously affecting good transport operations in Europe. Around 400,000 truck drivers' positions are unfilled as of today, driven by the continuously increasing transport demand until now, and as well as the aging truck driver population. As a reminder, the average age of a truck driver in Europe is 47 years old, and 1/3 of the truck drivers have more than 55 years old, globally speaking, in Europe. So as you can see on the graph, in the main European countries, so we took here France, Spain, Germany, Romania, Poland, and Denmark. Between January and September, truck drivers' open positions increased by 44%. And every quarter, at least 6,000 new positions are open. And in September, the main recruitment websites platforms have registered a total of 83,000 open positions. And with France and Germany having 23,000 and 20,000 vacant positions, respectively. Shortage is forecasted to be even far worse if we look forward and if we look towards 2026, notably, with a multiplier effect of up to 7 in the case of France, which is really linked to the age population of the truck drivers, which is around 30% having more than 55 years old. So we expect that in 5 years, they will go to retirement. And so we believe that this is a key issue of the industry that we need to even more monitor. And we are going to launch a report next week, really on this aspect, which is going to be on the attractiveness of the profession and exactly what is going to be the forecast of the driver shortage if situation remains the same, and also having a deep analysis also on the salaries and also on the cost of the license and the training to be a truck driver.
Yeah, that's brilliant, Marianne. I always love to see the new IRU data on driver shortages. It helps us really just to quantify the impact that's having, and it's great to see in this data here. Well, I say great. Interesting to see in this data how the crisis is really growing, and of course, we all know and understand why we're seeing some of those issues with the issues in the conflict in Ukraine, of course, being a major part of that. Yeah, so it's a problem which isn't resolving itself, and obviously that's helping to sustain higher rates with a lower supply of capacity in the market here. And this next slide, this is a really interesting piece of research as well, looking at the cost of training and the impact that has. So could you talk us through this one as well?
Yeah, so in fact, the barriers to access the truck driver profession is one of the key elements explaining the driver shortage today. And when we have a look on the graph that you see here, you can see that the cost, the comparison between the cost of the license to become a truck driver versus the minimum legal gross salary in the main European countries. And we can definitely see that high license cost is a barrier for newcomers to enter the profession, except in Denmark, as you can see, due to training subsidies provided by the government, it is expensive to become a truck driver. The license cost is in average 2,200 euro, which is double the average monthly minimum gross salary, notably, as you can see in France, with a license cost of around 5,200 euros to become a driver. Yeah. Mm.
Yes, interesting piece of research to be done there on the situation, how that correlates to driver shortages and how those government subsidies in Denmark might be helping to deal with some of those challenges as well, I suppose. Okay, well, thanks very much for that, Marianne. That's really interesting to understand how that side of things is developing. We'll now dive in, I think, to some specific lanes and take a look at what's going on there. So first of all, we'll take a look at the Madrid-Paris lane, one of our higher volume lanes that we cover. And we can see here, steep increases, but starting to level off a bit there in the last quarter. So Nathan, would you take us through this one?
Sure. Yeah, thank you, Michael. So again, we're seeing between Madrid and Paris, we're seeing all prices on this 1,270 kilometer journey hitting new all-time highs. And so when we're looking on the head haul into Paris, we're seeing that contract prices are now reaching an average of 1,570 euros. Now that's an increase of 2.7% quarter on quarter. While the spot market, we're seeing an average of 1,000. So we're seeing 1,899 euros per journey. And that's up 1.4% increase quarter on quarter, and now 33.4% year on year. If we look on the opposite direction, we're looking on the backhaul into Madrid, the contract rates reach an average of 1,406 euros per journey. And then that's a 1.8% increase quarter on quarter, now up 9.8% year on year, while the spot rates average 1,656 euros per journey. That's a 7.6% increase quarter on quarter, which puts them up 7.1% year on year. So what we're seeing now in this market as well is that the spot rates increased 1.8 times faster than the European average spot rates, and also 4 times faster than the contract rates on this journey, which means that we're seeing the divergence between the two markets on this lane. So, and interestingly, what we're now seeing, so data from September shows the first signs of rates actually falling back down, and rates fell by 1.3% into Paris and 6.7% into Madrid. Now, what we're seeing here is easing pressure on the demand side. So after starting the year quite strongly, the French economy is showing signs of weakening. So the National Statistics Body is showing a 4.2% year-on-year fall for the demand of food goods in France, while we're seeing it now below pre-pandemic level. And on the other side, we're also seeing, as I mentioned, the effect of the climate, where Spanish agricultural sector has actually suffered in some areas the driest summer for over 1,200 years. The wine harvest in both countries had been harvested earlier, so we saw some demand from Q4 pushed into Q3, and we're also seeing that we expect the Andalusian olive harvest to be around less than half of its 5-year average. Again, we're predicting less demand from the agricultural sector, and also with the wider production sector, wider industry seeing higher production prices, we can expect a softened demand for road freight in Q4.
Yeah, so expecting well, certainly less upward pressure, and probably that fall we're seeing in the latest data to continue there. Okay, thanks Nathan. Always interesting to hear more about the details behind each of the lanes and what's really driving demand there. Marianne, here we're looking on our Germany-Poland lane, Duisburg-Warsaw. Would you talk us through this one?
Yeah, sure. So as you can see on the graph clearly, all prices on this route have once again been pushed up to new all-time highs. On the head haul towards Duisburg, contract rates sat at 1.4 euro per journey in Q3. This is an increase of 8% quarter on quarter and 30% increase year on year. In the spot market rates on this route, it reached 1.7 euro per journey, up 5% quarter on quarter and 21% year on year. And on the backhaul, Q3 contract rates into Warsaw averaged 1 euro per journey, an increase of 4% quarter on quarter and 9% year on year. So finally, the backhaul spot market saw journey prices reaching 1.4 euro, an increase of 5% quarter on quarter and 11% year on year. So spot rates are now 23% more expensive than contract from Duisburg to Warsaw. This is one of the largest differences in Europe. Germany's manufacturing sector faces an extremely difficult situation, notably dealing with the growing energy costs and the energy supply uncertainties. And this is pushing Germany's manufacturing into decline, with a manufacturing PMI falling to an average of 48 in Q3, so meaning a 5 points drop quarter on quarter. This is the first clear sign that the German industry will begin to demand less and less road freight, as its factories demand fewer outputs and produce fewer intermediate and finished goods, knowing that the metal products represent the key product exchange on this lane. And on the other side, the Polish economy is showing clear sign of a slowdown. The country's PMI reached a 27-month low in August. Export orders are also falling, with ING reporting that surveyed companies link this to the weaker demand from Germany. However, the actual output of the Polish economy remains resilient, with the production of, for example, motor vehicles, trailers, and semi-trailers increasing 40% year on year. So we can expect a struggling German economy to demand fewer Polish finished and intermediary goods in Q4. But the resilient Polish economy means that the demand destruction on this lane is unlikely in the coming quarter, as a conclusion. Yeah.
Thanks, Marianne. Yes, there's a big challenge in terms of demand in the German market. Our TI's road freight forecast, which won't be coming out for a week or two just yet, but Germany is one of the poorer performing markets in terms of our expectations for volumes in 2023 there. And I think it's echoed by a lot of the data that you're pointing out there as well. So I think we'd expect to see rates seriously softening over the coming few quarters on this particular lane and across Germany really. But continuing really with the theme of the German market, but this time looking at international lanes to France. There's another picture here for Thomas, if you wouldn't mind taking us through this one.
Yeah, of course. So here we can see on this specific corridor, and mainly from Germany to France, where we have a very strong increase. It's the biggest one of the biggest one that we can see in Europe. From 1 year to another, we are up by 28% between Germany to France, and this is a bit less regard on the other way around, but this is still a high increase, and of course this is linked with the general economy level of both France and Germany. The IMF, for instance, is forecasting an increase of the GDP in France plus 0.4% next year, while it forecasts a decrease of GDP, so a technical recession for Germany. And we see from the graph that since the COVID, the French economy is better off than Germany, and so the demand of engineered goods, of the goods that are produced in Germany from France is higher. This is why the increase of prices is more steep in this side than the other. Some forecasting for next quarter, because we start to see the first data from the month we saw the month of October, and we start to see the new data for November. We have clearly a decrease of price, or at least the price won't go up that way, and this is mainly linked with the economy. Of course, France is importing a lot of engineering goods from Germany, and also automotive goods. And even if the demand for cars and automotive parts is better off right now than it was in the previous months, this is still at a very low level. And this is why we anticipate and we forecast a decrease of price in these two corridors from France to Germany and Germany to France in the following months. The decrease we won't go down to the level of the beginning of the year, for instance, but there will be a slow decrease.
Yes, thanks, Thomas. So for French economy, providing some needed stimulation really for the overall situation there, but obviously with fuel prices still high, we're still expecting to see rates relatively high. We'll turn now to one of the more dramatic markets over the last few quarters. You can see from the chart here, which is the UK lanes. Nathan, would you just walk us through what's going on here?
Thank you, Michael. Yeah, so this one is an interesting one. On the export lanes, we're seeing that prices continue to reach all-time highs. We're actually seeing evidence of import rates falling back down. So the import lanes, the British import lanes, experience Europe's largest rate falls in Q3, whilst prices on the export lanes actually increased 1.5 times the European average. Contract rates on the GB export lanes reached 132.8 points. Now that's an 8.2 point increase quarter on quarter, and that puts them still up 22.6 points year on year. Spot rates on the export lanes reached 157.1 points, and now that's up 8.5 points quarter on quarter, and up a significant 38.6 points year on year. And looking at the import lanes, contract prices fell by 1.2 points quarter on quarter, down to 130 points, but they are still up 5.7 points year on year. And then the spot market on import lanes fell by 2 points, down to 149.7 points, but that does still put it up 15.4 points year on year. So what we're seeing from the British economy is ONS data shows that consumption has been on a downward trend throughout 2022. And the seasonally adjusted volume of retail sales, excluding fuel, is down 5.3 points year on year at this point. The UK faced a worsening cost of living crisis, and it's putting more pressure on consumers, so we can expect this to continue. Now, while the rise in fuel prices has eased in the UK, food is now the biggest contributor to UK inflation rate, with ONS saying that it's now sitting at 8.8% for the average consumer. The UK's production volumes has also been on a downward trend as well. So it's actually only grown one single month during 2022. and the UK's production volume fell 1.8 points in August. So that's actually the largest drop in 14 months in the UK. And at the same time, UK producers face higher cost pressures. So their energy costs in the UK are up 500% year on year for consumers, with a 64.2% increase in August alone. So we can expect that we're going to see less pressure from both consumers and producers, with signs that export lanes are also seeing small falls in recent months. So dampening lower pressure, lowered upward pressure from both consumers and producers in the UK economy.
Yeah, and I'm afraid the outlook for demand in the UK market is not looking very strong. The Bank of England's assessment of the situation out this morning is for a 2-year recession in the UK. So, the pressure from demand side factors is likely to be very limited in the upward direction of rates over the coming period, though obviously there are also serious supply side constraints in the UK as well, with driver shortages, and probably the most acute in Europe. But moving on, I suppose, from the UK situation onto the Austrian road freight markets, particularly looking at these sort of obviously the international lanes here. This was a really interesting lane in Q3. We saw some of the biggest increases here. And this really is driven by what we saw as basically a fuel crisis in Austria. Obviously, there's the wider European fuel crisis and fuel price crisis we've seen from the Ukraine conflict. But in Austria, we also saw some very particular problems around refinery in Vienna, which was reduced to 20% capacity for a prolonged period during the quarter, which really did push up prices. And we saw, fuel surcharges go up and spot rates rise dramatically as well. And the Austrian government did, though, release hundreds of thousands, I think, litres of diesel from their reserves, which helped to alleviate that somewhat. But I was looking at the data this morning on Austria, and prices are still very high in terms of fuel prices. They haven't really softened too much from their peak during that crisis. So that's really what's been driving those kind of issues in the Austrian market. It's not an area of the report's coverage that we cover too much on the webinar, but really interesting market there. And we'd expect with those fuel prices remaining relatively high, prices to remain elevated, even if demand is softening, as it is across many other European countries as well. We'll move on to our final slide in terms of data. Anyway, here, this is one of our domestic, or one of Apply's domestic rate indexes here, showing the situation in France. And as we mentioned earlier, obviously the French economy is performing much better than almost any other market, certainly any other large economy in Europe. So it's maybe a different story here. Thomas, could you walk us through it?
Yeah, I will maybe talk a bit about the French economy. We talk about it quite good economies since the COVID, because of a lot of subsidies from the government. France is less impacted also by the energy crisis. We are less dependent on gas than Germany or other countries like Italy also. But once again, the coming months will be quite complicated for all economies in Europe and France also. I will just quote two figures that are quite funny, I think. It's from last report, Kantar reports that detail the consumption of French customers on charcuterie and cheese. And these two figures are: the consumption of charcuterie is dropped by 33% on the last quarter, and the cheese one down by 26%. And when French are not consuming charcuterie or cheese, this is not a good news. So we need to monitor that and to have a look. But clearly, this is a sign that the consumption is going down, and it will be the case for the following months. Of course, we have the same issue in France, where we have a driver shortage, and the population of drivers in France, French drivers, are really, they are the oldest one in Europe also. So the impact will be even worse in France. So we need to have a look on that. Demand that will be low, offer that is still low, so the prices will stabilize or go down a bit, but this won't be a sharp decrease of prices for sure.
Thank you, Thomas. So a bit of a different situation there. All right. Well, thanks very much, everyone. We've now moved on to the Q&A session. I can see we've already got 27 questions coming through on the Q&A. So what we'll do is we'll do our best to work our way through as many questions as possible to make
Maybe
sure
Michael.
the questions. Yep.
Yeah, I've go through the questions. A lot of them are on the data, and maybe I can answer 30% of them quite quickly. The data that you have seen over there are prices for full trucks load with all that is included. All is included in this price, meaning that the fuel is included. If you have specific tolls in a specific country, this is included also. This is all included. Prices on Upply or via TI, or you can have the prices without the fuel, but here we focus with the fuel. Ambient goods, this is also possible to have refers good, for instance, or hazardous goods. But on this report, this is only ambient, general cargo, full truck load with the fuel that is included.
Thank you, Thomas. Yes, I think that's just looking through the questions. Quite a few covered in that. So that's great. We have had a couple of questions around really the driver shortages and the impact of European policy on costs, as we often do. Marianne, I don't know if you'd be able just to address those. Obviously, mobility package was a big deal for us earlier in the year, and of course the effects are still there. But there's also a question here which is asking, what initiatives are being done across Europe to help alleviate the sort of demographic crisis in drivers, which I wonder if you could address directly.
Yeah, so for the mobility package first, so we are still at the beginning of the implementation in Europe. Only 6 countries have finalized the implementation of the mobility package regulation. So it is still difficult to make the assessment of the impact of the cost that we know are going to be mainly on the first stage on the administrative aspects, because there is this big new rule which is about the posting of drivers rules. So you need to indeed post the drivers on a specific platform, and this is going to for sure have an impact in terms of administrative costs. As of today, only 6 countries, as I said, have implemented the new rules. We have a dedicated site that we are doing from an IRU site. So maybe, Michael, we could maybe send the link of this website, because it is giving maybe to the participants exactly where we are standing in terms of mobility package implementation. So I think it could be a good idea to maybe to share this website. In terms of indeed demography and trying to attract the young, in fact, to the profession, many initiatives are today ongoing. The first one is about the access to the profession for the young ones, meaning in a way to make it possible for 18 years old person to join the profession. In Europe, it is not fully harmonized today. The European directive license revision is going to be finalized at the end of the year, and we are pushing from our side and with our members to make the minimum age to access the profession at 18. So making it possible for this population to join the profession. To attract them, so maybe to in a way to make the profession more attractive and interesting for the young. A lot of things are happening from our road transport national associations on the side, but also from a corporate side. So I can give, for example, what is doing the Spanish National Association, ASTIC, for example, having a program which is called Higher Level Education, which is in fact a kind of training for the apprentices that is allowing the trainee to make their apprenticeship in a company, and then it is helping this person to be then recruited. So it is facilitating the process for the young to make the traineeship and then to be recruited by the company. And ASTIC is a lot working with the government to indeed promote this type of training program. In Germany, BGL is also doing something which is called Initial and Continuous Training Support Program for the young, which is really aiming to promote the recruitment of the young population in the transport company. So a lot of things are happening today. We can really definitely say that it is even a lot more than the 2 or 3 years ago. So quite intense work. And so we hope that it is going to create a momentum and the possibility for the young to join, to be interested, and so to mitigate in a way the wave of retirement which is going to come in the next years.
Yeah, absolutely. Yeah, thank you, Marianne. There's a few questions here as well about countries that aren't covered in the presentation. Of course, Upply's data set is much broader than the ones we picked out here. We've just picked out some highlights. So if you want to see more data, do get in touch with the Upply team, and they'll be able to, well, you'll be able to see the wider data. So if you want data from the Netherlands, for instance, there's plenty behind that. I think, you know, another group of questions, trying to group them together in the interest of time here, we're seeing is a lot of people asking about the outlook for the, you know, 2023 and looking ahead to Q1 as well. I think we've tried to mention as much as we can how we're seeing pricing changing for Q4 and the trend we're seeing in the very latest data. Generally, you know, TI is expecting really demand to soften across most of Europe next year, and consequently we're expecting rates to soften as well. So we would generally across most lanes expect rates to decline. Though with fuel prices still high, we're probably not going to see those dropping down to the kind of levels we saw before the Ukraine crisis, including fuel and fuel surcharges in that. Thomas, do you have a view on a sort of more general level about rate development over 2023 that you'd like to sort of share?
Yeah, and I was looking at the Q&A once again, and we received more than 50 questions. So sorry, guys, but we won't be able to answer to all of them. But of course, the data that we have seen here are past data for Q3. Q3 was ended some weeks ago. But if we look at the coming quarter and the coming months, from my point of view, we will have the prices that will keep at a high level, maybe increase a bit more up to the end of the year for the peak season. But then, I mean, the structure of the demand will be lower. If we look at what is going on the sea freight market, so of course the structure is not the same, but sea freight rates are decreasing sharply. There was like a bubble in the sea freight industry, so this is not exactly the same, not at all. But we anticipate to have a decrease in prices, a slower down of prices, let's say, but prices will stay at a high level for the simple reason that the offer of transportation, because of the mobility package, because of the driver shortage, because of many others points, will be low. So offer will still be low. People are trying to do as what they can to bring new people on the driver side, let's say, but this won't be resolved in 2023. So from our point of view at Upply, we anticipate rates to stay at a high level, but we won't see big increase as we have seen during this year.
Yeah, very interesting. I mean, a few of the other questions are trying to drill into the issues around costs still increasing across most of Europe. Obviously, we're in a pretty high inflationary environment. We're seeing high fuel prices, labour costs increasing, the cost of all other sort of smaller cost components of road freight operation, whether it's tyres, tolls going up across Europe as well, maintenance costs, all these things increasing. So we do have a very interesting dynamic in the market now, where even though we're seeing, you know, volumes drop, those costs are going up, and that does mean that, you know, rates aren't unlikely to drop in the way that you might expect if you're just looking at the demand side of the market. So, you know, it's a very obviously very complex thing for us to try and predict, but obviously the data here is trying to help us do that as much as possible. And
Michael, if I just can add a comment on that, is that something that is quite new on the market, on the road transportation market, is this volatility. And I think that we will see this kind of volatility in the coming quarters and years, maybe not at a European level, but we have more and more, because of increase of cost, because of demand that can be very diverse between countries, and because of legal rigidity that are put on the market, we can expect to have a bumpy market with increase of spot rates that can be very high, while the contractual will be different. I mean, this is the year to come will be quite bumpy. I think this is the good word.
Yeah, absolutely. Yes, and that's one of the really interesting things, being able to look now at across spot and contract rates in detail with all the data sets as well. Really, I mean, if we take that example of the Austrian market that we looked at earlier, we can see that differential coming through really in the market, and obviously how those diesel prices are affecting it. So it's yeah, certainly very interesting. There's another question here just about that differential on spot and contract rates. And I know, Nathan, you've been looking at a lot of that while you've been going through the analysis. Do you have any general comments on the differential and how that's changing between spot and contract rates at the moment?
Yeah, I would say that one thing that we have seen is we've seen large rises in both markets. Now, likely because they're in the contract markets, the contracts pricing the increase in fuel. We're seeing those priced in a lot of contracts with surcharges. So that is also very susceptible to the rises in fuel that we're seeing. We can expect that the spot market is probably going to be more susceptible to the demand side effects that we're seeing, where this might have been putting a lot of pressure on throughout the year. So we might see that actually the fall in demand in some areas will be reflected in the spot market, but across the board, both are very susceptible to the high fuel rates and the volatile fuel rates. So we can see them kept high by any continued high rates into the quarter and the new year.
Thank you, Nathan. That's great. All right. Well, we've just hit our 45-minute timer for the session, so I'm afraid we won't be able to answer all the questions that come through. But obviously, if you do have follow-up questions, you're very welcome to contact any of the parties, IRU, on some of the supply side issue, driver shortages, looking ahead as well to that new forecast they'll be released in a couple of weeks. Of course, apply if you want those more detailed and granular rates on specific lanes. And if you'd like to see TI's forecasts and expectations for road freight development, please do get in touch with us with any questions. We'll be very happy to carry on that conversation with you. One last thing I'd say is that the report, a few questions just asking about that, that will be sent out to all participants following the webinar, and you'll also have a recording if you'd like to listen in again or share that too. So you'll be able to download that pretty soon and then read the more detailed analysis. Okay, so all that remains for me to thank you all for listening. Thanks very much for tuning in, and to thank our panelists, Nathan, Marianne and Thomas, for sharing their views today.